Good. I move now to the next topic, which is the example where we left last week. It's a very important example, and because of that, I want to explain it again quickly. It is as follows. We were discussing a pairs trade. In this pairs trade, what we were considering is an investment of a certain amount of money, $1,000 for reference, into two stocks, A and B. A was supposed to be a good one. B was supposed to be a bad one. And each of them was $100. We, sorry, we went through the analysis of how this trade could be done with different amounts of money. And we saw how this trade could be done with $1,000, with 500, or even with zero. And although the gain is always the same, it's always $36, the gain relative to the amount invested changed, gave us a return of 3.6 in one case, 7.2 in another one, which is double. And in this case, of course, it's infinity because we're doing this without any money. That's in the assumption of a certain rate of return. This is part of something important, which is referred to as trade financing. Okay, trade financing is how you can do trades when you don't have enough money, or when you don't want to spend all the money required. You already saw in one of the assignments how you could do the snow swap with leverage. We already saw that, okay? In the case of the snow swap, there was a way to do that with leverage. And you did yourselves the calculation of how with leverage the returns increase. Returns increase in absolute values. If they are positive, they get bigger, but if you're losing, you lose more. That is what leverage does to you. And this is no exception. It's the same thing here. The difference is that in this case that we're dealing with, the leverage is given directly by the market and by the, I guess, the ability of brokers to give us access to financing directly. Now, this is an impossible trade. It says it right there. You cannot do this. You need a certain amount of money to do a trade. You cannot just do your short, borrow, and use the borrowed money to buy your long positions. You can't do that. You need a certain amount of security. This depends on the particular situation that you're dealing with. So there is, with trade financing, there is an aspect of it which is trade margining. So margin refers to the amount of money you need to keep to be able to do transactions. This is a typical situation. This is a typical situation. You need to maintain 50% of the value of your long positions and 80% of the value of the short positions. The reason is that the short positions have higher risk. So brokers will impose a higher margin requirement for short positions, 80% typically, okay? This is typical. Sometimes you can get better deals, sometimes you can get worse deals, but we're gonna stick with this. We're gonna assume that this is the trade margining policy. And under this, we're gonna see how much money is actually required. So these are the trades that I'm doing. This is the margin that is required. For the long position, I require 50%, which is $450. For the short position, I require 80%, which is $720. Since I get $900 cash when I do the short selling of B, this is from the B short, we see that we need at least $270 to do this trade. $270 is how much we need to do this trade. This is the minimum margin that is required. With $270, we can see that we still make $36, so the result is almost 20%, 16.67%. This is the value of leverage. Okay, so this is what we discussed last week. But now I need to say something very important, which is to do a trade. This trade is possible, but it's very risky. It has a lot of risk. In fact, this trade is very likely going to generate a what's called a blow-up situation, or a default, or a margin call that you cannot meet. And this is the reason. The reason is, as you have margin, you have also variation margin, which is as you lose money, the trade requirements, sorry, the margin requirements will increase. So for example, if in this case, the value of the long position goes down, even if it's just a little bit, then the margin will not be sufficient. I have an example, okay? This is the effect of variation margin. This is the minimum amount of money we are required, but this will increase if the value of the portfolio decreases. We have to also take into account the effect of the portfolio decreasing. So for example, what I have here is a situation where the value of A will drop to 850 and the value of B stays the same. So B stays the same and A drops in value, $50. Okay? That means that we are now short $50. We need $50. If we only have 270, this is not enough. The need of $50 is called a margin call and has to be met immediately. Has to be met immediately. Under the assumption that that's all the money we have, this margin call will not be able to be met, and we have to raise $50 somehow. We will typically raise $50 by selling some of these securities that will generate cash. So a margin call, it leads to two situations. One is if you have money meaning cash, only cash, then you use cash. If you don't, then you need to liquidate. Then you need to liquidate. Liquidation is bad. It means, in many cases, it means that the end of your trading activity. Okay, liquidate is a bad thing. It very quickly leads to a loss of the investment portfolio. So it's something which is best avoided. Okay, not always, but oftentimes that is what it generates. Now, I hope this is understood. This is an important concept. So I want to pause for a minute and use the chat to see if there are any questions regarding this concept. It's an important concept, and I would like to make sure that everybody understands and has this clear. If there are any questions, please post them on the chat room. No questions? It's clear. Okay. Okay. So if there are no questions, then I will continue. There is something very important here that we just saw, which is something that I don't know if it is new to you, but if I go to this situation, the ability to do what's called position sizing means that when you're investing long and short, or when you are able to invest with a margin, with margining, with trade financing, then the amount of money you have and the amount of money you use is not the same. And moreover, as you decide how much of your available margin you put into the different securities, you have a lot of freedom to do that. But as you make those decisions, the risk profile of your portfolio will change. I have a calculation here that I don't know if, I hope you understand, but I'm going to explain. And this is called the probability of a margin call. Again, a margin call is bad. So this is the probability of something bad happening. Okay. So that probability can be calculated using our knowledge of the excess margin. That is how much excess margin we have. If the excess margin we have is a positive number, then if we assume that the portfolio has a Gaussian distribution, so the distribution is given by a normal distribution like this one, then the probability that we do not get a margin call can be calculated, and it's given by this formula. It's I don't know if this is something that you have seen when you have seen probability. I'm not going to derive this, but I will just mention that the probability I do not get a margin call in a certain time interval is given by this number. Exactly by this number. This is something that can be calculated. This is the probability that I do not get a margin call. Note one thing. If when A is 0, if A is 0, this number is 0. So I will get a margin call for sure, for sure. Okay, so this formula gives me an important fact, which is that in this case that I do this trade, I will get a margin call for sure with probability 1. Okay, as the number increases, the probability of the margin call goes down. So you have to, but of course, the probability of the margin call goes down, but also the return also goes down. So you need to find a balance between the probability of not having a margin call and keeping the return within a certain level. This can be modeled again using the Markovitch theory, because this probability of a margin call, what it does is it gives us a different version of risk. The return is here. So you're going to have some sort of an efficient frontier, and you have to pick that. When you do this, this leads to the thing that I mentioned earlier, which is position sizing. Okay. And you do this to maintain a high level of return, but also eliminating the probability of the margin. Okay. Some other, maybe two additional considerations. These are facts that I'm just telling you. I'm not going to justify them. I will just tell you that when you look at equity markets, bull period is when the market is up. And this is a bear. This is Howard here, but this is where the market is going down. What we can see is that when the market is going up, the correlation tends to move to the left. And when the market is going down, the correlation tends to move to the right. This is what's called wrong side risk, meaning that the market tends to have an effect which always works against you. When the market is going up, if your correlation is less, that means that you are not going to make as much money. And when the market is going down, your correlation goes in the same direction. Okay, it switches. So it's wrong side risk. This is not so good. Okay, and that is something which means that for portfolios that have a certain low risk profile, that risk profile is probably going to change as the markets go up and down. When they go up, things are okay, but not as good in the sense that the correlation is lower. But when the market is down, things are worse because now your correlation is aligned with the market. And there is a way to express this, which is how people talk about that, and that is with a short volatility, meaning that when the volatility is high, your performance is low. Okay. Okay. So that's one comment I wanted to make, and I just said it. Okay. So this ends our discussion on equities, how you trade equities. The next trading style that I want to discuss, which is also very quantitative in nature, is convertible arbitrage. And this is a style that has to do with the trading of convertible securities, which would be convertible bonds, convertible stock, things like that. I don't know if you know them, so I'm going to spend some time explaining what a convertible security is. And then I'll tell you how these securities are typically traded. And it all starts with one consideration, which is when a company needs financing, when a company needs money, you can do three things. The first thing that you do is issue debt. Okay, issue debt means that you're going to go to a bank or a creditor, a lender, and borrow money from them. Okay. This is what I call to use someone else's money. That's the first thing that you try to do. For healthy companies, this is typically easy, and they can do that. They can go to the debt market and they can raise money. This is how corporate bonds are created. Now, when that fails, the company can issue stock. The company can issue stock. You issue stocks, and that is a way to get financing. Now, what does that mean? That means that you lose control of the company to the new shareholders. you release controls, and you release upside potential. So that's the second best thing. And you do that when this doesn't work. So you do that when this fails. When this doesn't work, then you do that. But if raising debt works, then you stick with your raising of the debt. Okay, you stick with your debt. Shareholders are last in the lineup of creditors. In fact, shareholders in the event of a bankruptcy, they collect no money, whereas the bondholders can collect some money. Okay, but they are entitled to the maximum upside. So, in a certain sense, if you look at the upside and the security or safety of your investment, a bond has the best security, no upside, that would be a bond. And the stock has no security and a lot of upside, that's a stock. A convertible bond or a convertible security is something that you do when both of these things fail. When both bond and stock fail, to raise funding, what you do is you create a new instrument. It's called a convertible bond, which gives the investors the best of both worlds. So it's going to give the investors upside and security. That's a convertible bond. Right there. Okay? How does a convertible bond work? How is it created? A convertible bond is, first of all, a bond that gives the bondholders all the characteristics of the bond, especially all the securities of the bond. It gives access to the company assets in the case of default, and has a guaranteed rate of return and a coupon payment. Okay, so it's a bond. However, a convertible bond can be converted into stock. You can change your bond for a stock. That's how you access the upside here. This is what gives rise to the upside of a convertible bond. All right. Okay. So this is how you raise money when this doesn't work and stocks don't work. Then you issue convertible bonds. It gives investors the best of both worlds. Gives investors the best of both worlds. Okay? All right. How do you trade these bonds? These bonds are typically risky because the companies that issue these bonds, if they couldn't raise money with bonds or with stocks, these are companies typically which are very volatile and they present some risks. Okay? So they are usually issued by companies with volatile stock prices and lower credit quality. So investors, they typically want to profit from the upside presented by convertible bonds, but they would like to hedge the default risk and the market risk of investing in this. So how can you hedge the risk, the market risk, when you buy a convertible bond? So hedging is typically achieved by shorting the underlying stock. Okay? All right. We're going to see an example of this. Hedging has to be done carefully because stock volatility implies that the upside potential of a short position in the stock can create a lot of losses on the upside. That's where the convertibility features of the bond actually work. Okay? So let me show you an example. All of this is easier to understand in an example. So I have an example here of a convertible bond which sells at $80. The principal, as usual, is $100. So this is a bond that sells at a discount. Okay? And this convertible bond can be converted into 10 shares anytime. And the stock price is $7. You see, when you have your bond, you could convert it into stocks and then you only get $70. So at this point, you do not convert. You only convert if the stock price goes high, very high, okay? Otherwise, it'll get arbitrage. We also assume that we have an annual coupon for this bond, which is $4, and we assume that interest rates are 4%. So we're gonna set up an arbitrage trade for this bond. This is how we do it. I'm going to buy the bond. We buy the bond for $80. I short the stock. I short the stock. This is my hedge. When I short the stock, I get $70 in cash right here. And typically the $70 in cash you invest in a riskless security. In this case, I will use a treasury bill. And you see, that's how I use my $80. My $80 are broken up into these three types of trades: the bond, the short stock, and the purchase of a riskless security. This is riskless. No risk. Okay? So let's analyze this trade. Let's see what happens a year later. And I assume that the market is the same. So same market conditions. So the bond is the same, $80, hasn't changed, hasn't moved. The stock hasn't moved, still $7, which means my hedge is $70, still negative. The bond has given me a coupon payment of $4. And my investment in the riskless security in the T-bill has given me the interest rate, which is also 4%. So I get that. I have to pay some fees. The fees are going to be associated with the short borrower rate, which is 4 plus 1%. It's 5%. 5% of $70 is $3.50. And I can see that I made $3.33. So $3.30. That is my gain. Okay? That's if nothing happens. This is not a very interesting scenario. It is a scenario, but it's not interesting. Nothing interesting here. Nothing interesting here. So little risk and small return. In fact, if you notice, it's this almost the same return as the interest rate because it's about 4%. Okay? Not very interesting. Let's see what happens in this case. Let's say that the company goes bankrupt. The company goes bankrupt. My bond, which today is worth $80, a year later has lost almost all of its value. I'm going to assume that it's worth $50. This is the typical recovery rate. A recovery rate of a default bond is on average 50%. But my stock is now worth $0. And the bankruptcy, the stock is $0. That means that my short position on the stock is now worth $0. I have made $70. So this is a very good gain. That's why it's a hedge. The T-bill that I invested, of course, is not defaulted and still gives me 4%, $72.80. There's no coupon payment because this is defaulted. And the default is no coupon payment. It's only the recovery rate. Okay? And I still have to pay my short lending rate fees, $3.50. But what I see is that my $80 have become $120, almost. I have made 50% return, almost. This is a very good trade. Very, very good trade. I will make a lot of money. Let me continue and say, well, what happens in what I call an explosive success? See, the stock goes from $7 to $14. for example, the company is very successful, or the company is bought by a bigger company. Okay? What happens? Well, what happens is that my short position is going to lose a lot of money. It loses big, right? But my bond, I have the convertibility feature. I can convert into stock. Then I convert into stock, and then my bond becomes 10 shares, which is $140. You see, this is interesting. This is the interesting part of convertible bonds, which is they can be converted into stock. If there was a regular bond, I couldn't do that. My bond will probably be worth $100. That's the maximum. That's the maximum value for a bond. But a convertible bond, no. The convertible bond can be converted into 10 stocks, so it becomes $140. And I can see, well, my T-bill gives me 4%, and then I pay my fees. So the result is that I haven't lost really almost any money. Okay? I'm hedged. I'm hedged by the conversion. So these are something I want you to reflect upon, because here I have two extreme scenarios. Bankruptcy, I'm hedged, and in fact the hedge makes me a lot of money. This is my revenue generator. The hedge makes me a lot of money. And here I'm hedged by the conversion. The conversion gives me the hedge. So I have turned, this is very, very important, I have turned a risky investment in a convertible bond into a portfolio which is not very risky at all. Okay, this is the worst I have seen so far. We're going to come up with other scenarios. So we have a very good way of lowering the risk profile of a convertible bond trade. I have more scenarios here. Let's see what happens if there is some worsening, meaning that the company gets a little bit worse, just a little bit worse. The bond goes from, the convertible bond goes from 80 to 73 or 70. I have two scenarios here. Okay, number one, number two. The stock goes from 7 to 6. And I can see that in this situation, I still make money. I make good money. This is good. This is good. This is not bad. Okay, I make 4%, which is the interest rate. And then I have another scenario, which is if the company does better, but not so good so that I can convert, okay? So the stock goes from $7 to $8, but the bond does better, right? So the convertibility never kicks in. The bond is always more valuable than the converted bond. No conversion. Improving, but no conversion. Then I can go through the accounting and I can see that I make money in most cases. Here I lose a little bit. I lose small. Okay? So this is interesting because if I do a scenario analysis of this, what I see is that we have done 8 scenarios. In one, we make a lot of money. Okay, if I do a very simple histogram with my 8 scenarios, in one I make a lot of money. Okay, and in others I make some money and I hardly ever lose any money, or maybe I lose a little bit. Okay, it's like that. This is a very good distribution of returns from a convertible arbitrage strategy. Okay. Now, are there any questions? Is this understood? I want this to be understood. Are there any questions? If there is a question, put it on the chat, please. Okay, I don't see any questions in the chat, so I will continue. Now, I want to tell you how this is done in practice, because you can say, let's go back here. And this is a trade that was set up. So this is the hedge. And in this case, the hedge is what's called a full hedge. You see, I took 10 shares short in the bond because that is what my convertible bond would give me. Clearly, this was done with a view. There is a view here. The view is that the company will default. This is how you trade when you have a view that the company is going to default. Okay, and of course, under this portfolio, which is set up for a company that may default, what you have is a situation where when the company does default, you make a lot of money. It's very good. In a certain sense, it's too good, because if the company doesn't default, then your performance is not so good. It's kind of medium. So can you do better? What is the best you can do? What is the best hedge? And this is what we call optimizing the trade. Optimizing is finding what's best. How do we do this? So I'm going to show you. This is what's called scenario-based optimization. Okay? Scenario-based optimization. So I'm going to simplify the picture. I'm going to make a very simple picture in which I consider that there's only 3 scenarios. We have done 8 before. In practice, in a real situation, you may do 100 scenarios or 1,000,000 scenarios to Monte Carlo. Here we're going to do 3, very simple 3 that we can understand. Scenario number 1. The company doubles, goes from 7 to 14, and the bond goes to 100. But then, of course, I can convert it, so my bond will become 140. But the bond itself is 100, okay? That's the first. And let's say that it has a 33% chance of happening. This is the percentage probability of happening. That's my scenario 1. The company is going to do very well. It's going to become a great success. Great success. That's my scenario 1. And it has a 33% chance of happening. Scenario 3 is here, bankruptcy. Also a 33% chance of happening. And under this, I'm going to assume that my bond has a recovery rate of 30, only 30, not 50, only 30, and the stock is 0. That's my scenario number 3. And these are the extreme scenarios, great success and bankruptcy. And then scenario number 2 is here. This is things stay the same. There's a 33% chance that a year later, the bond has not moved and the stock has not moved either. Also 33%. How do you come up with these scenarios and these probabilities? This is what analysts do. They analyze the company, they analyze all sorts of conditions, and this is what you come up with. This doesn't have to be exact. In fact, no one knows if this is exact. This is what your view is. This is the analyst view. Okay? All right, so this is how you come up with your scenarios. We have done 8 scenarios in the past, and I just gave you, I didn't tell you the probabilities. Now I'm coming up with 3, but with the probabilities. And we want to decide what is the optimal hedge. So we want to buy the bond, we want to buy the convertible bond, but the question is, how many stocks we short? How many stocks we short? In the previous case, we shorted 10, but then we saw that shorting 10 was very good only in the case of bankruptcy. In other cases, it wasn't so good. Can we do better? So I'm going to come up with a number. This is my unknown. I'm going to say, I don't know. So I'm going to say I'm going to short X% of the stocks. So X is a number between 0 and 1. 0 means I don't hedge. 1 means I hedge 10 stocks, like before. X is a number between 0 and 1 and represents how many stocks I hedge in percentage terms. So 1 is 10, 0 is 0, because 10 is the convertibility number for this particular bond. And now I'm going to do the accounting based on X. So X is my hedge ratio. X is the variable I don't know. So I'm going to do accounting as a function of X. Because X, I don't know what it is. I'm trying to find out what X should be. So today, this is my trade. I'm going to hedge with 7X stocks, and I invest $70X into T-bills, and I have $80. All good, all works. Okay, I have $80, and X is my unknown. You see, it's right there. Under scenario 1, what will happen? What will be the value of my portfolio? Scenario 1 means that the bond is at 100 and the stock is at 14. So I convert my bond into stock, and then my bond is worth 140 after conversion, and my stock portfolio is now worth minus 140x. Before it was 140 because I hedged 100% of my stocks, but if I hedge only X%, my stocks are going to be worth 140x. And because I invested 70x on my T-bill, the value of my T-bill is 72.8x after a year, 4% rate of return. I will have to pay 3.5x to short my stock. The result is that I will have, under scenario 1, I will have $140 minus 70.7x. Okay, this is what we call scenario-based accounting. Under each scenario, I calculate my accounting, and the scenario is a function of one variable, X, which I don't know. We're gonna find it at the end. Under the second scenario, what I have is nothing changes. So the bond is the same, the stock short is the same, the T-bill produces 4%, the coupon payment is $4 for the bond, and that's the fee that I pay for the shorting. The result? That, $84 minus 0.7x. That's the value of my portfolio under a situation where nothing changes. Okay? And then, finally, under scenario 3, which is bankruptcy, my bond is now the recovery value, $30. The stock is worth nothing. The T-bill is still giving me 4%. This is riskless. It has a value, and no coupon payment, and I still have to pay for the short borrowing. The result is this. This is the value of my portfolio as a function of X a year later under scenario 3. So this is scenario 1, this is scenario 2, this is scenario 3. And I assume that each of these has a 33% chance of happening. So what I do from here is this. I can calculate the expected return and I divide by the standard deviation. This is what the Sharpe ratio was. This is what the Sharpe ratio was. How do I do my expected return? I have the return scenario 1, return scenario 2, return scenario 3. I take each of these values, value 1 minus 80, divided by 80, times a third. 33% chance of the value 2 minus 80 divided by 80, plus a third value 3 minus 80 divided by 80. That's my expected return. Because I have 3 scenarios, 33% probability each, and these are the values under each of these scenarios. That's my expected return. That is the numerator of the Sharpe ratio. And now I divide by the standard deviation. How do I do the standard deviation of this convertible arbitrage trade? The standard deviation is, once I know what the return is, I look at the return in the scenario 1, the return minus the mean return squared, a third, plus a third, the return under scenario 2 minus the mean return squared, plus a third, the return under scenario 3 minus the mean return squared, and then I take the square root of all of that. That will give me sigma. And I divide by one by the other. And when I do this, my Sharpe ratio is a function of x. So my Sharpe ratio is a function of x. And x is a number between 0 and 1. And I can do this in Excel. This was done in Excel. And when you do this in Excel, this is the graph that you have. Okay? That's if you don't hedge, and that's the Sharpe ratio if you hedge 100%. So I'm going to ask a question, and this is to see if you're awake, because the question is very simple. What is the optimal portfolio? What is the optimal hedge that you can do? You can write it on the chat or you can speak. What is the optimal hedge? A. What does that mean? We're going to short, the optimal hedge means we're going to short 8 stocks. See, in the previous example, we shorted 10. Shorting 10 made the return very good under the scenario of bankruptcy. But in the scenario of explosive growth, didn't work. We didn't take advantage of the explosive growth, and when the company got a little bit better, we also did not take we didn't take advantage of the company doing better. If we hedge only partially, which in this case is actually a lot, 80%, 30% chance of bankruptcy is very high, okay? But in this case, if we hedge only 80%, not 100%, then this gives rise to a better Sharpe ratio. Okay? This gives rise to a better Sharpe ratio. Any questions? Okay. So I hope this is understood. This is it's an important example. It's a little bit sophisticated. It's a sophisticated trade that we have. But I hope it brings many things together. It brings together a scenario-based accounting, brings into account the Sharpe ratio optimization, and brings into account considerations about the calculation of rate of risk and return. Okay, all right. So this is how you do a convertible arbitrage trade. Just like we considered position sizing for stock trading, there is hedge sizing for convertible bonds, and that is what we are doing here. This is how you do it. This is one way to do it. There may be others. Okay, here is some historical facts about convertible trades. This is a very famous convertible trade of Citibank in the year 2009. This is probably very far from your experience, so this is probably not something that matters to you very much. But I'll mention only one thing. It was, again, a very famous arbitrage trade. And it was famous because the company, Citibank, had shares that were very cheap. Shorting shares that are very cheap is very dangerous. In fact, in this case, the shares ended up being, I don't know where I have it, but the shares ended up being around $12. That was a 400% increase. It still worked, okay? And as we saw, of course, I'm shorting shares that are going to go up, but because the bond is convertible, then shorting shares which are very cheap is not risky anymore because the bond gives you a hedge, okay? So this was a very interesting trade from 2009, and Citibank went up by about 400%, and still the shorting of the shares was not helpful. In fact, this was a very profitable trade. It was a very profitable convertible bond. Okay, 2009. Okay, I'll just leave it there. It's a historical piece. And there's some remarks about how convertible securities have worked throughout history. Okay, MCI is the company that is mentioned. It was it started in the 70s in the US, and it was the first contender to the AT&T. It was the telephone company in the US. Okay, and they managed to grow by issuing convertible securities in 3 stages in a very successful deal. Okay. As the stock was doing better, it was forcing conversion, and then it made the bonds disappear from the balance sheet. That means that they could issue more bonds because the bonds were disappearing. This was a company that was worth more and more and more, and the bonds just disappeared from their balance sheet. Of course, they were turned into stock, but as the company was becoming more valuable, then that allowed it to create more and more convertible bonds. And in a few years, it reached a valuation. So it went from 161 million to 2 billion. That was in 5 years. Okay, so in 5 years, it multiplied its value by more than 10. Okay, 10 times return in 5 years. That's about 20% return per year. This was a very famous case, how this thing started. Okay, so there's many other examples here. Anyway, I'll just continue. Okay. Actually, maybe this is important. Short selling in Asia is somewhat restricted. So when you do convertible bonds in Asia, there's typically no hedging possibilities because hedging a stock is sometimes just not doable. Okay, there's not enough liquidity for shorting the stock. So these sometimes in this case, hedging not possible. So investment is done for the upside potential only. As more companies in Asia, Hong Kong, Singapore, as more companies can be shorted, convertible bonds will become more actively traded because you can hedge them. Okay, and this is important. It's something that I want you to understand. A long convertible bond goes together with a short stock, and even If you think the stock is going to do very well, even if you're very bullish on the stock, they still go together because they hedge each other out. The risk profile of your trade is decreased, is lower. Okay? That's where I want you to learn from this example. We have seen a lot of details, we have seen a lot of calculations, a lot of quantitative elements, but I want you to remember that the philosophy that makes this work is that a convertible bond goes together with some short position on the company stock as a hedge. Okay? All right. Good. I have another trading style, which is called merger arbitrage, sometimes also called event arbitrage, because here is you're trading events that may happen. And the one example I have here is it was an announced merger. It didn't happen, okay? Mergers are typically announced, and then the companies they have to ask for permission, they have to go to a shareholder approval and this and that. And sometimes that doesn't happen. So an announced merger sometimes happens, sometimes doesn't happen. In this case, it didn't happen, but this is how you can trade on a merger announcement. The companies were Alcatel and Lucent. They were all technology companies. They're all tech companies. Again, in 2001. Okay, so a long time ago. And in this case, Alcatel had a better credit rating than Lucent. Alcatel was A- and Lucent was BBB-. Of course, if they merge, the rating converges. That means that the Alcatel bond and the Lucent bond will end up being rated the same, and therefore they will be worth the same. So if they're going to be worth the same, then you can think that the Alcatel bond is expensive and the Lucent bond is cheap. Okay? So what you go is you go long the Lucent bond and you go short the Alcatel bond. That's the trade that you do. You go long the cheap security and you go short the expensive security. This is like when we did long A, short B. Remember that trade that we did earlier? Except you do this with bonds, not with stocks. Okay? That's how you do it. When you do that, in this particular case, you stand, if you look at, I just tell you the numbers, you stand to make about 8% return in just a few months, which is a very, very good rate of return. Very good rate of return. And because you go short at one bond and long the other bond, you can do this with margin financing. So this is something that you can do very profitable. You can make this very profitable. Okay? But there is a big risk. The big risk is that, for example, in this case, if this deal doesn't happen, and in this case it did not happen, okay, and if you enter the trade early, then it's okay. You don't make money. So if you're early, you're okay. You don't make money, but you're okay. If the deal closes, then you make a lot of money. But if you're late, then it's very risky. Because if the deal doesn't happen, then you get to lose a lot of money. Okay, you have to be early in this. This is why people who are in this style, they are very busy. They're very, very busy because they have to analyze all these trades very quickly, and they have to decide if they have to get into this. So when an announcement is done, that day you basically do not sleep. You just make sure that you get all your analysis done right. And then you try to get into the stock position very, very quickly. Sometimes you don't have time to do the analysis. You have to follow your instincts and then do a trade very quickly, maybe a small trade, just to get a foot at the door. And then you do the analysis later. But if the analysis doesn't work, then you need to get out very quickly, because this is a trade that can be very risky. Okay, so this is a very risky. And typically, this is also what's called a binary trade, because it depends on something happening or not. So it's like a yes or no. type of situation. Okay, in what we saw earlier, the stock could go up this amount, down this amount, the bond could go. In this case, it's very radical. It's yes or no. Yes, there is a merger. No, there is no merger. Okay, typically that's so these things have almost a digital payout, and they're risky for that reason. But that's how these trades work. Now, and I think I want to skip over this. These are trades. Fixed income is when you try to exploit pricing differences in fixed income securities. We saw. I mean, this is complicated because when you do, it's the same style that you do when you trade stocks. Exactly the same. The difference is that when you trade stocks, understanding the stock value is a number. When you trade bonds, you're really trading a curve, the entire yield curve. So because of that, when you trade differences in the price of fixed income securities, there's many considerations about different terms, about the dynamics are more complicated. Okay. You can swap instruments with different credit qualities. It's a sophisticated style. But I want you to know about it, and I do that by using just one example, which is something that used to be very common. It is not common anymore because LIBOR is going away, but this is what's called a TED spread. This is the Treasury minus the Euro-dollar 3-month rate. Okay, so this is the spread between the 3-month LIBOR and the 3-month T-bill rate. It's called the TED spread. This is Euro-dollar based, so you trade this with a Euro-dollar forward, for example, trade, and this you do it by trading T-bills. So fixed income securities. The TED spread is an indicator of the credit risk in the general economy. When the credit risk is high, the TED spread gets bigger, and vice versa. So you have to. This is how the TED spread evolved over time. And again, these are numbers from a long time ago because these things don't exist anymore. There's others which I'll show you. Okay, so when you look at the TED spread is basically this difference. This difference is what makes the TED spread. So here the difference is very small. Here the difference is very big, right? So when it's big and you think it's going to go small, you go short. You go short the spread. And when you think the opposite, you go long the spread. And the advantage of these trades is that you can do them on futures. And futures are very efficient margin-wise, because the margin we saw for stocks, we had 80% and 50% margin for stocks. For futures, it's sometimes 5%. That's the margin for futures. But we're going to see this soon. Okay, so again, you would set up a long position on the T-bill and a short position on Euro-dollar future. That's your view, and then you can see that you can make a 1% 1% spread. And if you trade on margin, a margin that is only, say in this case, is 10%, then you invest. This is the invested capital, which gives you access to a full $100 bond, and then your P&L is 15 cents. On a return of $11, which gives you an annualized return of about 5%. So, okay, I'll continue. This is one of the rates that is taking over, and that's the difference between LIBOR and the overnight index swap rate. But even this is getting obsolete because LIBOR is disappearing in this year, 2022. Okay, so this will have to be changed by other things. The same concept applies. Okay, now this is a more interesting trade. This is called relative value arbitrage, and I have a good example that explains it. But what relative value arbitrage is you're going to go long and short a certain security or groups of securities. you typically go long the cheap one and you go short the expensive one, knowing that they will converge in a certain way. So I have an example here of what happened to the euro in the year 1998. It's a very good example because on December 31st, 1998, the euro will officially become a currency. And because of that, the demand for euros was so high that they were very expensive. It was actually cheaper to buy any of the constituent currency that was going to become the euro back then, okay? And except for the British pound, all others were guaranteed. Okay, so you could buy the euro in a synthetic way by buying either of those currencies underneath. And the demand for euro was so high that you could buy not the euro, but the constituents of the euro at a 98% value. So that's a 2% discount. Now, a 2% discount, when you know you're going to be making money for sure, is a very big deal. 2% discount when you're going to be making money for sure. Okay, so you have 100% profitability. It's very good. The only question here is how can you obtain margin? Because if you don't have margin, you can make say 2% in 1 month. You do this in December, 1 month. That's very good. This is about 20% annualized. But if you can do this with margin, with leverage, as you did in your assignment, then you can make this number even higher. Okay? So this is how relative value arbitrage works. Okay. Now, the next style I have is something that is very specific to North America, to the United States. And it is what's called Regulation D, or private investment in public equities. Private investments in private equities, which are PIPEs. Okay? And these are rooted on some regulation that was done in the year 2002, 2003, I forget exactly. It's the Sarbanes-Oxley regulation. This is something that happened because of the Enron scandal. You may not know these names, but the Enron scandal created the Sarbanes-Oxley regulation and makes when you want to issue, as a company, if you're going to issue new stock, okay, new stock, this regulation makes it difficult and slow. It takes time. But if you need money quickly, there is a way to get money quickly through Regulation D, which is part of the U.S. Securities Act of 1933. And it allows companies with public shares to issue new restricted shares. The shares are restricted through private deals, and then these shares will become public after a period of time when the filing is done, typically a year, for example, right? So this is a way in which you can buy stocks cheap, but these are new stocks. New stocks meaning new shares issued by old companies, not new companies issuing new stock. No, this is new shares issued by stocks, so by companies who are already listed. So this is a type of trading which is some sort of a regulatory arbitrage because it is caused by regulation, and it does allow for buying stocks at a discount, and some institutions they do that. I don't know that these kinds of things exist in big numbers outside of North America, but in North America they are a big deal. Okay, they happen. Another example here is distressed securities. How you can make money by buying a company which is doing badly. And there are many examples of this. I'm not going to mention any name, but I'm going to show an example. Let's say that you have a company that is that has bonds which are on distress. And here I'm assuming, let's say that the full notional value of their debt is 100 million. Okay? But it's sold at a discount. This is almost bankruptcy level, 50%. 50% discount, which is default recovery rate. Okay, very cheap, very cheap. So what you do as an investor is you buy the whole company, you buy the debt, and this is very important. You hire new management. You change the company around. Typically when you do this, there's things that you do. This is typically done by very big players who have stakes in other companies. So you buy the company and maybe you get rid of some of the service providers, you replace them with your own service providers, you just change the company internally. So maybe it'll cost you some money to do some internal restructuring of the company, and I just put a number there. And let's say that by doing that, you manage to move the company away from bankruptcy into, this is still cheap, okay? This is still cheap. But not as cheap as 50%. This is 70%. This is still cheap. But you can do that by changing the company around, and you don't have to do many things to the company. You just have to make it a little bit better. And if you do that, and you see, because the bond was so cheap and it has a coupon payment which is of a certain size, you can make money very quick. Not very quickly. You can make money on your bond issue by just bringing the value down from a very rock bottom, almost default recovery price to something more meaningful. Okay, and this is something that many companies do. You don't need to. You just need to drive the company out of bankruptcy. That's it. If you drive a company out of bankruptcy, there's a lot of value creation in that. And in this case, my calculation shows 42%, which you can probably do over a year or two. Okay, a year or two. And it's critical in this case. It's absolutely critical that you need to have new management in the company. The company has to be managed according to your rules. Okay, you don't just buy the debt and just wait for the debt to get better. You need to fire management. You need to put your own management, and then get the company out of bankruptcy very quickly. Okay, that's another style. Now we are reaching one of the most interesting ones that became very famous in 1992 is global macro. And this is a style that likes to take advantage in variations in securities prices. You have to make a forecast of the world economy, okay, typically, political developments, macroeconomic variables, and then you exercise your views by participating in the futures market, currencies, indices, commodities, interest rate, whatever it is, okay? And then this is how you make money. You make money on world views. And I have an example, a very good example. This is an example of George Soros. George Soros is a very famous Hungarian person. He's very rich now. And he had a view that in 1992, this is a very famous trade, very famous trade. All European central banks in the 90s, they wanted to create the euro. The euro didn't exist, as you saw earlier, it was created in 1998. There was a precursor of it, which was the ECU, European Currency Unit, or I forgot, ECU, okay, ECU. And they wanted Great Britain, they wanted England to be part of that. Okay, and in order to do that, someone like Soros said or thought, his analysis showed that the weight that the British pound was given in the euro was too high. So the British pound was being overvalued as part of their mechanism to enter the euro. So he was sure that that was not sustainable, and eventually the British pound would come down in value. This was way before Brexit. Okay, has actually nothing to do with Brexit, but it looks like Brexit just many years ago. And in fact, at some point, I think it was September 1992, indeed, this tension just could not be sustained. The British pound left the approach it was having toward the European Union. The British pound dropped by 20%, and when you're short the British pound that day, you make 20% in one day. Okay, so that value was gains for this type of trading style. Okay, global macro. Now you would see similar things, people trading on the situation in the Ukraine. You can trade. This is creating tremendous price movements, and if you trade based on your views about where those price movements are, then that will be also global macro trading. Okay. All right, and the last example that I'm going to talk about before we end class in 10 minutes is futures. This is a very interesting, one of the most interesting trades because it's very old. It's been around for a long time. It has to do with trading in futures markets. The first exchange was in Osaka in the year 1697, and that was for rice. And the way a futures market works is as follows. You have people, like in the case of rice, you have producers and consumers of rice, right? And there's price uncertainty. You don't know what the price of rice is going to be. There's price uncertainty. So what you do is you reach an agreement between producers and consumers that at a point in the future, they will buy and sell rice at a certain price. This is what happened in Osaka in 1697. And when you do that, the exchange is the one that guarantees the price. It's like the stock market, but for rice in this case. Okay, so if for whatever the reason the price of rice is higher or lower, the obligation to buy the rice at that price stands. And although you may say, oh, I have to buy rice and I have to pay more if the price is lower, well, that's not a bad thing, because you do that to avoid the situation that you pay more if the price is higher. Okay? It is a way for bidders and askers, or consumers and producers, to remove risk from the uncertainty of prices in the future. This is what a futures exchange does. They've been around for a long time. Of course, now you have risk exchanges in many parts of the world, Singapore, London, Chicago, and you can do similar trades for agricultural products. You can do similar trades for financial products, metals, for many things. Okay, rice also, but rice is now a very small commodity. In the 19th century, agricultural products they were traded all over the North American Midwest, but then Chicago developed the concept of the clearinghouse. They became the futures market for agricultural products, and that's why Chicago became a very big city, very successful. And so this started in the 19th century. In the 20th century, it only got bigger, because now we have futures markets for all sorts of things. And I have some examples here of the futures exchanges that exist all over the world. And there's more. This is just a short list. Okay, and futures markets have a lot of money being traded on them. So there are trading styles that use trades in futures markets to buy something that you think is going to go higher in price, or short selling something you think is going to go lower in price. Okay, so this style they only trade in futures markets only. Futures markets have the advantage that they provide only initial margin, and margin is very low. It's about from 5 to 10%. Compare this to stocks that we saw earlier today. The margin there was 80%, 50%. Here is 5 to 10%, much lower. So the access to leverage is higher. Okay. We also have variation margin, as we saw. So you are not careful, you're going to get a margin call. But it provides very inexpensive access to leverage. Very inexpensive. All right, and they're also regulated differently. In the US, they are regulated by the CFTC. In other jurisdictions, regulated by other entities. All right, so there's essentially 5 types of managers that trade on futures. Trend followers, who basically, what they do is they just follow trends. When they see inflation going up, they buy gold, for example. Okay. Short-term traders, they trade on volatility. They are typically intraday, meaning that by the end of the day, they close all their positions and they start again tomorrow. Fundamental, that's very similar to the macro traders, very similar. Okay. In fact, if you can exercise your macro views on the futures markets, then you will be a fundamental CTA, commodity trading advisor. Mechanical, these are the people that use computer algorithms. And discretionary are the ones who would do computer algorithms with a human overlay. In other words, you have your computer giving you signals, but then you interpret the signals and you decide what you're going to do. Okay? All right, so this gives rise to a very interesting trading style, lots of volume. And you get involved with currencies, you get involved with agricultural products, you get involved with a very large collection of commodities. And it's going bigger and bigger. Now you're going to start trading carbon, which is very popular in China right now. You can trade other climate issues. And guess what? Can we trade snow? Well, this was our original example. We were doing a snow trade, right? Now, that was a bit of an exaggeration, but now you're beginning to be able to trade things that look very much like our snow fund, because you can start to trade weather derivatives. Still not in the futures market. They are still over the counter. They are still very, but they are growing. And what's happening with carbon trading is a big deal. It's probably, maybe in a few years, I'll be changing my snow swap example by a carbon trading example. Okay, because these kinds of things are beginning to be very, very popular. They have other advantages. They have no credit risk because the exchange guarantees payment. So in the case of my snow fund, we saw that the ski resort didn't pay and then you lose money. This doesn't happen here because the exchange guarantees payment. There's also no liquidity risk. In our snow fund, we had a tremendous liquidity risk because we only had so many snow swaps. That is not what you have in the futures market. The futures markets are huge. So there is unlimited supply and there's also no capacity constraints. In our case, we were limited to $2 billion. It looks like a lot of money for a single trade, but $2 billion for the whole market is very, very small. Futures markets are much bigger, okay? So they have no capacity constraints. There's something very interesting happening here, which is it's called model risk, which is there are different models that people use to do the analysis of the trades that they should do. So these things are difficult to analyze. Stocks, you have a lot of accounting information, you can have better models, but for example, predicting weather has a very big effect in the price of many of these commodities, especially the agricultural commodities. And the things that we don't understand weather, we don't know if it's going to be a warm summer or a cold summer, for example. So many of these methods of trading have model risk built into them, and if you make a mistake, this could have bad consequences to your trades. Because of that, this is an area where there are increasing numbers of a model innovation, okay, or sophistication. Whether drought, for example, drought has tremendous impact on the price of agricultural products. Another example. Okay. Okay, so I think with this we have seen a lot of the styles that are relevant out there. One comment that I want to make is this is what happened to you. 2008 is the year of the crisis. But look at this. CTAs did very well, very, very well. This signifies negative correlation. And we saw that if we have a portfolio with negative correlation in it, then the risk of the combined portfolio is lower than the risk of its parts. We saw that. So in this particular case, this is interesting because it shows that the CTA or the futures trading works as a very good diversifier against other styles. And that's why people, they typically do their stocks and bonds, but then they do their CTA portfolio as a diversifier. You see, when things go bad, sometimes these guys do very well. Okay, it's here, negative correlation again. Okay, so I think I'm gonna leave it here. And this is another style. I have 1 minute left. I think I'm gonna leave it here. Are there any questions on today's lecture? We just finished the trading styles. This is the summary of all the different trading styles that exist. We started with equities, then we went to convertible bonds. We saw futures, we saw fixed income trades, and other things, including takeovers in the case of distress, and other things. They all have their own risk profiles, they all have their own trading strategies, they all have their own. But at the end of the day, it all boils down to the same thing, which is risk and return. And we saw how the Sharpe ratio came up again as we're trying to optimize our convertible arbitrage trade. So the same constants happen to come up all the time. Any questions? No. Okay, so then time is up. I will see you next week. I will give you the next assignment over the weekend, which will have to do with the trading strategies that we saw today. And I will start with a new topic next week, which is investment products. We have seen investment strategies now. We will start to review how investment products are constructed using the investment strategies as the main building blocks. We will do that next Friday evening. Okay? Bye-bye.